But we also talked about the fact that for the gold shares to begin to participate as stocks, they had to participate as companies. And the margins that gold producers enjoyed didn't match the increase that one would have expected with the increase in the gold price. That's easy to understand because at the same time that the price of gold went up, the price of inputs, the price of cost to produce the gold went up too. Social rents in particular have increased at 20% compounded. Labor has increased, energy has increased. What you are coming into now, however, is a period where the companies have done a reasonably good job at cost containment, and they are beginning now to enjoy the increase in the gold price and increased margins. In the next 4 weeks, we're going to have a lot of quarterly reports. And I think we're going to have a lot of upside surprises in the near term.
Gold prices have risen over 30% this year, so it's no wonder that miners are headed for a record third quarter earnings season. But other technical price factors could add to their future bullishness. However, the rest of the market has yet to catch up on the potential opportunity in gold miners. That opens the door for investors to catch gold mining stocks before they eventually run higher. Thus far, gold miners have been trending higher, but they haven't done so to the degree they should in relation to gold bullion's year-to-date surge. RickRule is the former president and CEO of Sprott U.S. Holdings, with decades of experience in the commodities business. Based on trends, he highlights the disparity between gold prices and mining shares, pointing out that central banks buy gold but not gold shares, accounting for the share performance lag. From a technical standpoint, Rick mentions that rising costs limited gold producers' margins despite higher gold prices. However, improved cost management will lead to better performance, with upcoming quarterly reports likely showing positive surprises, especially for companies like Agnico Eagle and royalty firms. According to O'Daly, analyst Bob Lucas stated on the X platform that gold mining stocks have surged by 70% this year and have finally started to outperform the rise in gold prices, similar to the trend seen after a bull market confirmation. However, their prices remain below the highs of 2020. While gold's performance remains volatile, there is still significant room for growth. In broader economic trends, Rick anticipates a rise in mergers and acquisitions in the gold mining sector due to underinvestment in exploration and permitting delays. As margins improve, he expects companies to expand through acquisitions, leading to increased deal activity on Wall Street and Bay Street. Now, we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
What I suggested is that, first of all, the disparity between the gold and the gold price was easy to understand. The central banks were buying gold, and central banks don't buy gold shares. So it makes sense that the follow-over wouldn't happen in the gold shares. But we also talked about the fact that for the gold shares to begin to participate as stocks, they had to participate as companies. And the margins that gold producers enjoyed didn't match the increase that one would have expected with the increase in the gold price. That's easy to understand because at the same time that the price of gold went up, the price of inputs, the price of cost to produce the gold went up too. Social rents in particular have increased at 20% compounded. Labor has increased, energy has increased. What you are coming into now, however, is a period where the companies have done a reasonably good job at cost containment, and they are beginning now to enjoy the increase in the gold price and increased margins. In the next 4 weeks, we're going to have a lot of quarterly reports. And I think we're going to have a lot of upside surprises in the near term, particularly with companies that have traditionally been good on the cost side. The Agnico Eagles of the world and the royalty and streaming companies, the Wheaton Precious, the Franco-Nevada. But I think that you're going to see it come down into the secondary tier too. You've already seen an absolute blowout quarter from Lundin Gold. And I think that you're going to see, with increasing frequency, gold mining companies on all ends of the size scale surprise to the upside with the quarterlies. The second thing that I think you're going to see, and we talked about this before too, is because of the long lead times, because we've underinvested in exploration, and because of the permitting delays, you are going to see a lot more merger and acquisition. The only way companies are going to be able to grow in the near term isn't with the drill bit, and it isn't with the bulldozer. They're going to have to grow on Wall Street and Bay Street. We've already seen mergers and acquisition through the space. And I think the pace of that, as margins increase, and as the cost of equity capital perhaps begins to fall, I think you're going to see a lot more M&A activity. If you believe that the gold price is going to go up, and as a consequence of that, you buy the whole gold sector, you're going to buy a bunch of crappy companies. You need to do the work, not just understand that the gold price is going to go up. You need to do the work to segregate between the good, the bad, and the ugly among the gold companies. If you buy the sector, you'll go broke. If you select well in the sector, particularly during times of increasing gold prices, you will do well. But it's up to you to do it. It's up to you to invest better. It's up to you to save more. It's up to you to add value in your work. All of it's up to you. The headwinds, or pardon me, the tailwinds that you've enjoyed for the last 40 years, I would suggest are over. You can do very well in the next 10 years if you apply yourself, because other people won't make the transition to a value-based economy. But that's where we're going.
Expert analysis explains that if the market set interest rates, they would likely be 2.5% to 3% above real inflation, not the artificially low CPI rate. RickRule expresses concern that low rates penalize middle-class savers while benefiting investors with access to credit. Over the past 4 decades, he underscores, those with credit access have prospered while traditional savers have struggled. Recent price reports on goods and services, despite being a bit stronger than expected, indicate that the rate of inflation over the past year is getting close to the central bank's 2% target. In fact, Goldman Sachs recently estimated that when the Bureau of Economic Analysis later this month releases its figures on the Fed's favorite price measure, the inflation rate could be close enough to be rounded down to 2%. In his analysis, Rick predicts that artificially low interest rates have widened the economic gap between the top 5% and the rest. He warns that globalization, with cheaper labor in countries like India and China, will expose this mindset. Let's get back to the interview.
I think one reason is artificially low interest rates. If you had free market interest rates, if the Fed didn't set the interest rate in the US, but rather the market set the interest rate, my suspicion is that the interest rate would be 2.5% or 3% above the real rate of inflation, not the CPI stated rate of inflation. Artificially low interest rates penalize savers, middle-class savers, and they benefit investors. They benefit people that have access to credit and access to the knowledge as to how to employ it. In other words, they benefit me, but they penalize middle-income savers. And people in the last 40 or 45 years who have had access to credit and the education necessarily to employ credit, at least in the period 1982 to 2022, have done very well, myself included. Those people who haven't had access to credit or haven't had the knowledge base necessary to employ it have had challenges. And those people who relied on traditional methods to get ahead, including savings, have been penalized by deposit interest rates that were lower than would otherwise have been the course. So yes, I think that artificially low interest rates have been an important part in the demarcation, the economic demarcation between the 1% conservatively, probably more like 5%, and the 95%. I think another point has been the fact that we lost sight during a period of economic boom that you had to develop specific skill sets to get ahead. You make money by delivering value to people. The service that you sell or the good that you sell has to deliver enough value to the consumer that he or she willingly parts with money. The idea that many people in the economy have is that you trade time for payment. There are a lot of people who don't have the disconnect between the utility that you create in your job and the way that you get compensated. The economy was strong enough and benign enough for a period of time that people could just show up and collect their checks. That period of time is no longer true. It was particularly true, of course, in the West. But in terms of globalization, what we've learned is that there are a bunch of people in other parts of the world who are willing to do things that we used to consider to be our sole province, and they're willing to do them better, and they're willing to do them for less money. The idea that an auto worker in Western Europe or the United States who is 55 or 60 years old can employ capital better at $70 an hour than a 24-year-old can employing that same capital in India or China is fallacious. And I think that the rank and file of the citizenry needs to reestablish the connection in their own mind between the value that they contribute at work and the way that they're compensated. And I don't think that that's true. And I think it's going to be a very rude awakening to people who haven't figured it out yet.
To entice investors, miners are trying to show that they won't make a similar mistake this time. Yet companies are signaling they're wary of repeating errors made in a previous bull market when mega expansions left them with big debts and angry shareholders. With gold prices rising and the market dynamics shifting, are you prepared to take advantage of potential opportunities in the gold mining sector? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.